Good afternoon, everyone. My name is Matt Tepper, and I am the marketing manager here at GDS Link, and I will be today's moderator. First and foremost, we hope you all are doing well considering the current unique circumstances, and hope you all are continuing to stay safe. We want to thank you for taking time out of your day today to join us for today's webinar, The Future of Eligibility. Today, we will discuss how other industries have tackled the challenge of consumer eligibility, highlight the key functionality lenders should focus on when establishing their own adaptable processes, and how GDS Link specifically has leveraged our resources and processes to help our clients reach the right customers. Just a bit of housekeeping before we get started. If you have any questions during the presentation, please type them into the Q&A box in your Zoom control panel. In the interest of time and getting everyone in and out within 30-40 minutes, I will address any questions toward the end of today's presentation. The slides from today's webinar will be emailed out to you all later today, and today's webinar will be recorded and made available for viewing through our website, gdslink.com, and our social media channels. If you have not done so already, I would encourage you all to follow us on LinkedIn and Facebook, where you can stay up to date on latest industry trends, as well as GDS Link's latest offerings. Before we get started, I wanted to provide a formal introduction of our speaker today, Chris Keene, a recognized leader in consumer credit and e-commerce. Chris is currently the Vice President of Business Development here at GDS Link. Prior to his tenure at GDS, Chris headed up the consumer lending business at Barclays and managed the mortgage product portfolio through the 2008 financial crisis. He is well-versed in the actions which need to be taken to manage a crisis and its aftermath. Most recently, Chris was commercial director at Money Supermarket and has a wealth of experience delivering financial solutions to customers digitally. Reducing the reliance on personal interaction is vitally important as we manage the short-term risk posed by COVID-19, and Chris is passionate that we take the lessons of what can be achieved at lower costs and greater convenience to customers into the new world which emerges after this current crisis. Looking forward to a very engaging conversation this afternoon. And without further ado, I'll hand it over to Chris. Thank you.
Thanks very much, Matt. And thank you everybody for joining. Thinking about the future of eligibility, certainly the UK has done well as a market in terms of giving consumers choice when they're choosing financial products, and you know, looking across adjacent industries. Certainly the insurance model has become extremely well developed in the UK, and we've all become very well versed in terms of choosing our insurance based on price across a wide range of providers. The development on unsecured lending products has followed closely, although it does feel a little in recent years that the personal loan and credit card development has got a little bit stuck. It's got so far, but actually, what's the next innovation that's going to come in choosing financial products, particularly those unsecured lending products? And that's really what I want to explore today. It's probably worth just having a brief look at history. And if we go back to the 1990s or maybe the early 2000s, you know, we were reliant on listings of financial products in order to make a choice. These listings were helpful, but depending on the legislation at the time, at 1.66% of customers had to get the headline representative rate in the listings. That eventually dropped to 50%. So, you know, 50% of the customers reading a listing weren't going to get the product that was actually available to them. Yes, we were all engaging more digitally. You know, from personal experience, some of the aggregator sites were significant introducers of volume, you know, as far back as the very early 2000s. But the actual customer experience that people were going through there was quite limited in terms of the information that was provided to them. As we came out of the credit crunch, things started to improve, and we saw likelihood scores becoming more normal. So, you know, with a likelihood score, it's definitely a step in the right direction from a consumer perspective. Users are able to compare the rate that's available and the likelihood that they're going to be accepted. But actually, as they go towards the lower rates and perhaps a lower likelihood of acceptance, the chances of them getting the representative rate advertised is fairly low. So, you know, I might be clicking on a sub 3% rate on a loan, or I might be clicking on a 28 or 29 month offer on a credit card. But if the likelihood of acceptance is low, then actually I'm unlikely to get that product, and what looks like 2.9 as a very attractive headline rate might be 5%, 10%, or 15% by the time I've actually got through to an application, and there is a significant risk that I'm not going to be accepted. That certainly added value to the service that aggregators were providing, and certainly for the customers that were able to get high likelihood scores and attractive headline rates. There was a sort of upper cohort of customers that were both attractive to lenders and valuable to aggregators in that respect, but it didn't really solve the whole problem. Things improved with pre-approval, and this has worked particularly well on prime credit cards, where customers have for some time been able to see whether they are pre-approved for the best offer available from a lender, and if they are pre-approved for that best offer, then that's typically the offer they get when they click through to the lender. It doesn't work for everybody, so many consumers still see an eligibility score on credit cards, they still see the attractive headline offer, but actually when they get through to the application, they may be downsold to a product with a shorter duration or a product with a higher fee. So it doesn't really deliver that certainty. And the other thing that's a challenge on credit cards is that customers don't know what limit they're going to get. So yes, I might be pre-approved for a 28-month balance transfer, but if I've got a £5,000 balance to transfer and I'm only offered a £2,000 limit, actually maybe I would have been better off choosing a different product. And bringing that into the into the service is something that we feel strongly should be introduced. Real rates has made a start, and real rates on loans is very much about what is the rate you can actually offer me, not what is the representative rate. On credit cards, it's what's the best offer that you can give for me. And if someone has a balance to transfer, I want to know that what's the best deal I can get on a balance transfer for my £5,000 that I've got sitting on another card. There may be a 28-month headline product, but if the best product available to me is 20 months and the fee's a bit higher, then actually that's what I want to know. Real rates has made a start on loans. We've seen some of the more innovative lenders connect directly to aggregators and deliver a good service there. But actually, the choice that consumers are still faced with in many instances is a pre-approved offer from a newer lender, perhaps without the household name that they'd expect from some of the retailers or major banks. And alongside that, they see a lower rate, but it's not pre-approved from someone that they know very well, maybe where they do their weekly shopping. And they face that choice. Do I click on 2.9 representative rate, or do I click on 5.9 pre-approved? And they don't at that point know what they're actually going to get. We believe that consumers should be able to choose based on real rates across a wide range of lenders. And the kind of table that you see illustrated here is the sort of experience that we'd expect to be able to deliver if this wide adoption of the real rate service that we're looking at. A final frontier for consumers looking at financial products on aggregators and other platforms is the ability to apply for a loan. All of the steps that we've looked at so far have added value to the service that aggregators provide and ultimately delivered better quality and more valuable leads to lenders. The big challenge at the end of the process, as we see it now, is that while it's a consistent and slick process to get to what is the best product available for me, there's a lot of inconsistency in the downstream application process. At best, this can be a click through to a lender application that's almost seamless, and the customer's instantly confirming that they're in the right place, that they want the loan for a certain value, and that they're comfortable with the rate they're getting, and they're straight into pre-contract information. But at worst, it can be fairly rudimentary pre-population of application forms, lots of additional questions, friction around identifying who they are and making sure that they pass various KYC and AML checks. So, we believe there's a long way to go there. And actually, I think the challenge for the industry as we look at that is what can be done to work out equitably where the efficiency improvement that an origination process would deliver, and how that can be equitably shared between the lenders and the aggregators. If that can be done, then we believe it should be better for consumers, because ultimately with less friction, they'll find the right products and be happy with the choice that they've made. It'll be better for aggregators because with higher conversion, their clicks will be worth more. And it should also be better for lenders, as they should be able to offer a higher revenue per click to aggregators at a lower CPA. And it's working that piece out. So that's where we see the journey going functionally. But the functional side of things is only part of the story. There's quite a lot of detail in the actual steps in the eligibility process that can make a big difference to the throughput that's achieved, and whether the right answers are delivered for different customers. Traditionally, there's been a real tension between, on the one hand, the ease of use of the process. How many questions do I need to answer? How likely am I to need to go away and double check information or get additional details? And then at the other extreme, the fidelity of the decision. This has meant that all processes are a bit of a compromise, and there's a dropout rate for the best quality customers who potentially get bored with answering multiple questions. And there's an inability to offer firm offers to higher risk customers because the processes just aren't comprehensive enough to actually identify what's their true financial circumstances and what sort of product would be most appropriate to them. We see a new approach changing this, where the journey becomes much more dynamic and is really based on how easy the decision is or how low risk the decision is from both a lender perspective and a customer outcomes perspective. And an easy decision should be delivered with few questions, minimal friction, minimal dropout rate from the best applicants, and minimal adverse selection as a result of that. So if we've got someone who's got a high income, relatively low borrowing compared to their income, and they want to switch from one credit card provider to another, that should be a really slick, easy and straightforward journey for them. A higher risk customer who's potentially had financial difficulties in the past, they need a much more careful assessment, and they would also expect to answer more questions. And actually, rather than it being an adverse selection problem, they'd actually value a more comprehensive process where it feels like the offer that's being made for them is the right offer based on them sharing appropriate information about their finances and ultimately finding a solution that's right for them. And even if additional borrowing is not the right answer, the solution should go as far as suggesting where they can seek help in order to sort out their finances. In terms of the way we actually we see this working, the current processes are clearly illustrated on the left-hand side, but largely what you've had is a static set of questions. There's a little bit of dynamic questioning in there, but it does things like, if you don't have a sufficient, if you have less than 3 years at your current address, then it will ask for a second address. But it's not being dynamic based on the customer's financial circumstances. What we're suggesting is that instead of asking a standard set of questions, we seek the bare minimum information in order to identify the customer and to get an initial rudimentary understanding of their finances through a single bureau search. Where the customer is a new user to a site or service, then this is the basics of name, date of birth, address, etc. Where the customer's already got a relationship with, let's say, a credit scoring platform, then the journey should start with their existing information and also the monthly credit score that they get as part of that service. This can already then start to tailor the type of questions that they'd need to answer in order to get a new credit product or service. For the prime customers, it means that they'd have to answer few or even no additional questions in order to receive some offers. And for riskier customers, it can go into a more in-depth process to make sure that they're fully understood and can make sure that that they found the right product. We see the lenders actually setting the questions and service settings based on their risk appetite. So we'd expect the prime lenders with the very best headline products that are getting the best quality customers to have relatively brief processes. But even within individual lenders, they may have tiers of process based on their risk appetite. So prime customer with great income cover has to answer very few questions. a riskier customer with limited income cover, they want a better understanding of income and expenditure. And then, you know, for higher risk lending, the lender panel would be requiring additional information from the customer and also potentially calling additional services. This can also be dynamic to, you know, the specific needs of the customer. So, you know, if we have a customer that's in file, then potentially open banking data is very powerful to provide something to supplement the limited credit profile. If the customer's had financial difficulty in the past, then a more detailed and tailored income and expenditure questionnaire is going to be helpful to them. It's going to show that the service is rigorous in terms of understanding them and finding the right product, and can potentially be supplemented with open banking data to verify the answers to the questions that they provided. So all of this can then make a service that is appropriate to individual customers and ultimately delivers the right product for them. We also see a sort of relationship here with COVID-19. There will be a lot of personal financial difficulty as a result of that. That is going to upset some of the conventional measures of creditworthiness, and being able to call additional services at that point, particularly open banking, you know, could well be a very good supplement to the assessment process and allow customers to have access to credit that would otherwise be more difficult for them. One thing this doesn't do is it doesn't deliver the complete set of results that some customers expect from some of the more traditional aggregation services. So we have an additional service that we can provide here, whereby a handful of lenders would be targeted to provide a real rate offer to the customer. Those real rate offers, pre-approved, would sit at the top of the table. But further down the table, let's say a customer's getting a 3 or 4% APR from a prime lender. They want to know that we've asked a subprime lender whether they'd lend to them or not. They're not really very likely to ever want to click on that product, and seeing that there's a low chance of acceptance at a 50% APR from a lender that's appearing 30th or 40th on a list of products just gives them that certainty that a thorough job has been done. But it doesn't require the data being transferred to all of the lenders in order to get that understanding. So how does this all hang together as a system? Well, this is, you know, high-level schematic of how we see things working, and two ways for lenders to connect. Now, the first thing to say is clearly there's already been connections directly between lenders and aggregators, and where those connections and the volumes of business are sufficient for those to be strategically important to both the lender and the aggregator, they've worked well. However, very quickly, a many-to-many connection model can run into issues. Building and maintaining multiple connections across multiple lenders and multiple aggregators can be challenging for both parties, particularly when they've got other big conflicting technology priorities. And we believe that GDS can play a significant role in both simplifying the system and also making sure that the system works on an ongoing basis. So, you know, what do we offer? We offer a solution where lenders can connect and control business real time from multiple aggregators. So the lenders are able to say which aggregators they're on with, which aggregators they're not on with, and have real time control over that. Aggregators can connect to multiple lenders through a single connection and get multiple real rate responses. So that works well from an aggregator point of view. I'm not trying to maintain 6 connections to get 6 responses. I should be able to maintain 1 connection and get 6 responses. And both lenders and aggregators get real-time information about the sources of business and the destination of the leads that they're sending. And they can set their own exception criteria and flag any issues that they see arising. Some of our conversations suggest that, you know, these monitoring processes work, but they're not automated and they're not standardized across multiple connections between different lenders and different aggregators. You know, alongside that, GDS will manage the real-time service assurance across all connections and acts as the point of escalation for anything flagged by any of the lenders or the aggregators. So there's an overall ownership of the infrastructure. and making sure that that service is assured on an ongoing basis. In terms of the lenders connecting, they have two choices. If they have a decision API, they can share their API. They set their filtering criteria in the control system. So they will only see the cases that they want to see based on their filtering criteria. If they don't have an API, they can host their credit strategy on GDS software in the cloud. So this is a cloud-based solution. It doesn't require technical implementation from the lender perspective. What it does require is just expert business risk users to set up the strategy and make sure that it's working appropriately and making the right decision. But very much that is a solution for lenders. We're not asking for anybody to share their credit strategy with us. We're just providing the tools in order to host a credit strategy in a user-friendly software that allows that strategy to then be exposed to the outside world. I said already, lenders set their own filtering criteria. So all lenders set their own filtering criteria, and ultimately it's the lender's choice as to how they set that. So, on the one extreme, lenders could set their filtering criteria almost completely open. So they get to see all of the credit applications coming through from the comparison services. The downside of that is that they both need the system capacity and they'll incur the assessment costs of all of the quotes that they're responding to. At the other extreme, they can set those. At the other extreme, they can set those filtering criteria quite tightly, and they'll see far fewer applications. And there is some risk that there'll be false negatives at the filter. Over time, lenders get the data in order to understand what business is coming through, and they can optimize their filtering criteria to get the best balance between seeing the customers they want to without driving any false negatives. From a user perspective, the user is presented with a set of questions driven by the lenders they best match based on the filtering criteria. And that lender panel is optimized based on both the rates available from the lender and the brevity of process. So lenders with if the customer has 6 lenders with market leading rates, all saying that they can respond with a minimum of questions, the customer will see the minimum of questions and will get real rate responses from those lenders that have the market leading rates. And once completed, the answers are shared with the panel of lenders, and the real rate responses are returned from the lenders to the comparison service so the user can make a choice at that point. The final challenge as we see it is once the customer has got this real rate result on the comparison services, what do they need to do in order to fulfill the loan? And as we said at the start, there's been a real inconsistency in terms of the downstream journey that customers face as they click away from an aggregator service or a credit platform and into a loan application. In the US, we've got services running where the loan can be fulfilled in a single journey. So, once the user has clicked on a real rate, you're straight into providing bank details to set up the payment. That includes KYC, AML, and fraud checks. And from a lender perspective, where standard KYC, AML, and fraud checks are acceptable, that's absolutely fine. But the lender journey from this perspective is fully configurable, so it can call whatever services with whatever settings the lender chooses. So, from that perspective, there's no need to divert from standard signed off KYC and AML processes. The lender can retain complete control from that perspective. For higher risk lending, open banking can be included at this point. We've got instances running where open banking is used at this point to do a couple of things. First off, it can be used to verify what the customer has said about their income and expenditure and make sure that that all stacks up. It's also a helpful additional control whereby if a customer can log into an online banking service, then there's a good degree of certainty that they are who they say they are, and adds an additional control there from a KYC perspective. We've got built pre-contract and contract documentation, and this can be rendered from lender templates without compromising on content or layout. So, concerns about presenting the right document to the customer with the right formatting and making sure that adhering to CCA regulation and various other bits, that can all be addressed by making sure that we fully render the lender's documentation, and the loan or card at this point can be e-signed, and the journey is then complete. And we do believe that this could deliver a very significant uplift in the conversion from click on a comparison service to sale, and ultimately stop people dropping out and potentially having to go through suboptimal processes to get the product they want. So to wrap up, we think there's still a lot which can be done to make it easier for consumers to find the right lending products, and to make the costly business of acquiring the right customers more efficient for lenders and aggregators. Using the right flexible technology that can accommodate the myriad of processes and services used to assess creditworthiness, identify customers, prevent fraud, and provide clearer choices to consumers, is what we see as the answer to this. And ultimately, if we can get this right, it will deliver better customer outcomes. People will have access to the right products with complete clarity as to what they can and can't get. It will deliver more income for aggregators because the end-to-end process will be more efficient. So the customers that they acquire through their own digital marketing activity will ultimately convert into sales more strongly. And it should deliver lower acquisition costs for lenders as well, as higher conversion means that even if the CPA is lower from a lender perspective, the higher conversion means that the clicks will be more valuable to the aggregator, but the lender should share in the benefit of a more efficient process. Thank you very much for listening.
Thank you, Chris. We did have a couple of questions trickle in. For those of you still on the line, if you do have any questions, feel free to submit them on through the Q&A button at the bottom of your Zoom toolbar. First question that we had: what has stopped lending becoming like insurance, where consumers can get a wide range of prices very quickly across aggregators?
Yeah, thanks, Matt. I think there's probably a couple of elements to that. Certainly, from a technology perspective, there's been significant challenges on the part of the lenders. If I look at the big banks, they've always got many other technology priorities, and finding the time and space to build effective digital connections to multiple distribution partners is something that's not been done well historically. The API narrative in the big banks is improving, and I think roll forward another 5 years and it'll become more common to connect. But that technology challenge has been a real issue. The other thing that historically has been a barrier and has only really moved on in recent years is what can be done in terms of providing quotation searches to customers, and how far that journey can go before it becomes a credit application, and whether that affects the credit worthiness of the customer. Those barriers weren't there so much in insurance, and that allowed insurance to accelerate away. So I think from that perspective, we look back to the early 2000s, it was normal to be able to get 50 insurance quotes at the click of a button. It was at that point, it hadn't even really started on the credit product. So the credit products have started from a later starting point, and they're still playing catch up.
All right, our next question: what will the impact be of lenders allowing their financial products to be fulfilled on an aggregator site?
Yeah, I think it's an interesting question, because I think there's some understandable reticence on the part of the lenders here, and there's a fact, and then there's a question of how that fact gets resolved. So the fact is, from a visitor to an aggregator site through to someone getting a loan or a credit card, the conversion rate would be much higher if there's a super slick, consistent fulfillment process across a range of products. And the ability to be on an aggregation service, click the "Get It Now" button, and effectively, be in the checkout rather than being halfway through the process, is something that would deliver significant efficiency gains in terms of that customer journey. And it would stop customers dropping out, because they start to get worried that they're having to repeat information, and maybe what they thought was a yes might become a no, and and various other things. So, you know, it would deliver a better customer experience. It would deliver greater efficiency. I think the challenge for the lenders is the concern that ultimately it gives more ownership of the end-to-end journey to the aggregators, and how does the efficiency benefit get shared out equitably? You know, if leads are converting far more strongly, historically CPAs have tended to only go one way, and I think there needs to be a different way of looking at the overall commercial model to make that work for everybody. But if that can be resolved, then there should be more customers visiting aggregator sites, resulting in them taking a financial product, and as a result of that, it should be better for lenders and it should be better for aggregators.
All right, our next question here: how can lenders be sure they have fulfilled their AML and KYC obligations if they use third-party origination?
Yeah, so certainly the way we see any origination process operating is there'll be two options. There'll be a standard set of services that sit within there, which we believe should be sufficient for a lender to have fulfilled their requirements in that respect. But very clearly, lenders have their own governance processes and their own risk appetite around these things. So this is based on, you know, our software, which would call whatever services the lender wants to call, with whatever settings and configured in whichever way the lender wants them set and configured. So, you know, from that perspective, we're not saying that any lender would need to do anything differently. They could operate their KYC, AML, and other checks in exactly the same way as they operate in their own channels. It just creates a slicker journey for customers while still making sure that they fulfill all their requirements.
A question that just came through our Q&A: what would you say is the acceptable average cost per application for pre-screens and qualifying on consumer lending with GDS Link?
So I think Matt, sorry, could you just repeat that? I'll just make sure I get it right. Is it the overall CPA or just our bit?
Yeah, absolutely. Sorry, what would you say is the acceptable average cost per application for pre-screens and qualifying on consumer lending with GDS Link?
So I think there's an overall cost per acquisition through aggregator channels, and I think, you know, those costs are something that is a commercial negotiation between the aggregators and the lenders. And so as far as that side of it goes, I think, you know, that is still a relationship between the lender and the aggregator. I think, you know, from our perspective, very happy to have a conversation with anybody that wants to talk about the specifics of using our service, either from a lender perspective as to, you know, what that cost is, or, you know, from an aggregator perspective, what is the cost of providing a broader service to the aggregator so that there is this lender-friendly platform that people can connect to as and when they see that they want to offer a real rate service.
All right, and then one final question that we have here is, are you proposing that credit card offers come with limits as well as the details of the offer?
So a general consensus that we seem to have gathered is no, with a couple of qualifiers. So I don't think there's much appetite for there to be if you like, a limit arms race amongst credit card providers. I do think there is a genuine requirement on the part of customers to be able to understand who will give them the best card that fulfills their financial need. And if their financial need is to transfer a balance of £5,000, they need to know the best card that will accept a £5,000 balance transfer, but they don't necessarily need to know who's going to give them a £10,000 limit and who's going to give them a £15,000 limit. So I think that's the answer on balance transfers. Similar on 0% purchase offers. quite often customers have a specific purchase in mind as a starting point. They need to know that the card can fulfill that requirement. Perhaps the only area where limits become important is when you're looking at prime customers who are typically paying their balance off in full every month. They may be interested in who gives them a bigger limit because they're putting their work expenses through the credit card. They know what their monthly spending is. They know how much headroom they need. And they might make a choice between one rewards program and another based on both the richness of the rewards and does the card give them enough headroom in terms of limit so they can make sure that they're never getting close to limit. But by and large, customers need to know that they can get a card with a big enough limit to meet their financial needs. They don't need to necessarily know which card gives them the biggest limit.
All right, and I think with that might wrap things up for us this afternoon. Thank you all again for your attendance this afternoon, and thank you, Chris, for your insights. We obviously hope this was a valuable resource for you all today. Again, these slides and a replay of today's webinar will be available to you all later today via email, as well as on our website, gdslink.com. Thank you all again, and have a great afternoon.